don't know if this sounds familiar to you, especially if you grew up in an Asian family or Asian culture. Go to school, be obedient, keep your head down, study hard, get good grades, graduate from university, get a good job, especially in a large MNC, spend below your means, save as much as possible, retire with a comfortable life. Now, does it sound familiar? Well, it is for me, and I'm trying to ask you this question in this video and trying to answer them as well. Is that advice practical in today's inflationary world? Over and above inflation, there's also this thing called currency debasement. Now, if you don't understand that, don't worry, I'm going to answer that in this video. But more importantly, how do you get out of this inflation and currency debasement problem? Now, that's the purpose of this video today. So for those of you new to the channel, my name is John, formerly an engineer, turned full-time investor, currently wealth planning director at Phillip Capital. And I'm also the author of an upcoming book called The Malaysian Multi-Baggers that talks about companies that have at least 10x within the past 20 years in the Malaysian capital markets. Now, before we go into strategies to overcome inflation and currency debasement, I think I do need to define certain terms that I'll be using, which is related to money supply. And there are three kinds of money supply: M1, M2, and M3. So M1 money supply just means the most liquid form of money, and that is usually used for immediate transaction. Usually it consists of currency in circulation, traveler's checks. When I say currency in circulation, means your immediate notes, your coins, and last but not least, demand deposits, which is usually your checking account. The M2 money supply, it includes everything in M1, plus things that are less liquid. So things that can easily be converted into cash, like your fixed deposit, your retail money market funds. The third money supply, which is M3 money supply, includes everything in M1, M2, but includes large time deposits. It includes institutional money market, so government to government, short-term repurchase agreements, and for some countries, they even stop reporting M3 money supply because they probably have a specific agenda for it. But yeah, I just needed to define those M1, M2, and M3. And I will usually be referring to M2 money supply, which is near money, immediate money, plus money that is less liquid, but very near-term liquidity. That means you can convert into cash within 1 to 2 days. So with those definitions out of the way, now let me explain why money supply has a strong correlation to inflation as well as currency debasement. Now imagine the entire economy is one slice of pizza, and you probably got 4 slices from that pizza. One of it is in your pocket. Now the government suddenly cuts this pizza into 8, instead of 4 pieces, it cuts into 1,000 pieces, which makes it smaller. Right now, instead of having 1/4 of the pizza, you have 1/1,000 of these pizzas. You're having smaller or thinner slices. That actually is debasement. They print more slices. They make the slice that you are saving in your pocket for a rainy day or for the future less and less in actually value. So correlating that to this graph of money supply and purchasing power, as you can see, the money supply line is keep on rising, going up and up, and the purchasing power is the line going down and down. Now, this is the money supply line actually represents the government printing money, introducing more money into the system because it needs to pay for debt to fund government spending. It needs to also stimulate the economy. They also do that by actually lowering interest rates so that businesses can borrow cheaper at a lower rate for them to start a business or to expand or to scale. And the victim, for the lack of a better word, are actually the normal citizens and their purchasing power, because as more and more money is being introduced into the system, inflation rises, the currency displacement happens, and what you are purchasing is getting more and more expensive. Not necessarily because the value of those things go up. Like for example, look at property, right? The property didn't really like increase in value overnight, right? But because of inflation and currency debasement, that's why housing prices, that's why stock prices actually go up. And it's currency that you are using today. If you understand the time value of money, the $1 today that you own will not be the same $1 in like 5 or 10 years. Don't even give it 10 years, give it 5 years from today. I mean, look at what we used to buy when I was a kid. We could buy, a loaf of bread for like 50 cents. And I think if you go even further, I think a loaf of bread only costs like 10 cents. That is another analogy how I would describe, the correlation between money supply to inflation and also currency debasement. So the joke I like to share within my circle of clients as well as people who invest together with me is that if your money is sitting still, it's actually melting, like Olaf in the movie Frozen. Lame joke, I know. So the hard truth is this: if you're relying on your salary and savings account, then you are going into a gunfight armed with a knife or a dagger. How on earth are you going to win the fight? So moving on to the second point is really compounding versus stagnation. I think most people mistaken that when they see a rate of return, they take that as real return. But real return is actually calculated by having a nominal interest rate, which is probably your savings account or fixed deposits, time deposits, net off your inflation rate, because only then you can really gauge what your real return is. So if the bank is paying you 3% on your time deposits and you are getting a return, you're getting an inflation of 7%. So net your real return is -4, Is that keeping up with inflation? And is your purchasing power still maintained by you putting as much money as possible into fixed deposits? So there was a point of time when I conducted a class, and I was just showing this money supply line and correlating against the amount of money being poured into time deposits. And it was a straight correlation. That means the more money the government printed, any government, not just the Malaysian government, the US government, the Chinese government, the Japanese government, and I use the example of Malaysia, more money was being poured into fixed deposit. So then what is your real return? You are actually debasing your own currency because of not putting into assets that grow faster or even bigger rates than your inflation rate. The third point I would like to highlight, and I think this is very, very important, especially for those younger generation. Time is actually can be used as an ally rather than a foe. And why do I mean by that? A lot of people, whenever they haven't started investing and they're so fearful of losing this money, they procrastinate and they say that, okay, we'll wait for a better opportunity, we'll wait for a market. 1,001 reasons why they shouldn't start, right? And I use the analogy of going to the gym, and it's like, okay, I'll start investing when I have money. For me, that is very similar to say, I will go to the gym when I'm fit, right? If you think about it, why do you go to the gym? Because you want to stay fit, because you want to be healthy. But in investing terms, if you only wait till you have enough, then only you start investing, then likely you're going to drag, and you are not using time as your ally to actually compound capital. Because even at $1, but you compound it 5 years earlier than someone who started 5 years later than you, that $1 had 5 years of opportunity to compound. That, I think, is the very key to really starting your investing journey. Yes, there are risks involved in investing. You cannot eliminate risk. But what is the real risk? The real risk is actually inflation. It's slowly but surely chipping off your purchasing power every day that you wait. That's the reason why savers are being crushed in a high inflationary ecosystem or environment. Because if you think about the business model of a bank, how do they make money? They make money only when they loan out. Even higher interest rate, even better, right? But for them to loan out money, they need to have an inventory of money so that they have the capital to loan them out. And where are they getting that inventory from? Those that are super conservative, that are loaning them or putting money into time deposits and savings account. Savings account even better if you put like $1 million into savings account, giving you 0.02% return, right? Is that really efficient use of or an efficient way to allocate your capital? Because the banks will happily take this $1 million, paying you 0.02 interest rates, and they're going to loan out to maybe even a conservative home loan would get them anywhere between 4, 5, or even 6%. That spread is what makes the bank money. And I think for you to really get out of this hamster wheel and to really compound your money is to really own businesses that the banks are actually lending to. Especially if the bank, a very conservative bank, and the bank knows that this business is very likely to pay them back. Why are you only enjoying 0.02 when you can actually ride on a business that can grow and scale 20, 30, 40%, even sometimes 50%, that these banks feel very secure to lend to? Why are you not enjoying that ride as well? I think that's the key point of this video. You know, rather than being conservative, how can you be, not to say completely risk-free, but how can you protect yourself with the skill sets to invest in businesses and become an asset owner? So the takeaway from these videos are actually pretty simple. First, do not behave or think like a victim. Yes, property prices, asset prices, food prices will continue to go up. And if your wage inflation or wage increase is not in line with the inflation increase, then what are you going to do about it? There's no savior going to come and, you know, bail you out. Maybe you can get lucky, you buy into a lottery that, you know, you strike overnight, but that chances is 1 in a million, right? So rather than thinking of how to save money and be super conservative, start thinking about how do I acquire assets. Then the next question would be, if I were to acquire assets, what assets give me the kind of liquidity, the kind of return, and the kind of risk-adjusted return that you should be looking at? Because everyone's personality is different and everyone's appetite for risk is also different. But not doing anything about it and not understanding the risk and inaction, in this case, it is very detrimental, especially if you drag it over 10, 20, 30 years of your life. So rather than, you know, be analysis paralysis and just don't want to do anything, hide your head like an ostrich into the hole, I think spend that time to educate yourself. Find partners to guide you along the way, to actually help you grow your mindset, to help you actually grow your assets as well, so that 10, 20 years from now, rather than, you know, complaining and lamenting about it, you're prepared with options. So I hope that, you know, all those news headlines today, market's gonna crash, market's gonna, you know, have negative territory, all that, as you educate yourself more and more, the confidence will actually come on how you should safeguard your own financial independence. I look forward to seeing you in the next video, and take care.